If you're watching this, you probably know that keeping your cash in the bank isn't the smartest move. With inflation slowly eroding its value and banks offering meager interest rates, it's time to rethink where you put your money. What if I told you that there are 14 assets out there that are better and safer than cash? From real estate to stocks to precious metals, these alternatives can not only preserve your wealth, but also grow it. In today's video, we'll walk you through these 14 assets in detail, so you can make informed decisions and finally stop keeping your cash in the bank. You'll learn how these investments can help protect your hard-earned money from inflation, market volatility, and economic uncertainty. Before we begin, if you haven't already, please hit the subscribe button. It means a lot to us, and by subscribing, you'll gain access to more unique insights on how to build wealth, live smarter, and secure your future. Now let's dive into it. 1. Real estate. The timeless, tangible asset. Real estate has been a cornerstone of wealth for centuries. Unlike cash sitting in the bank, real estate is a tangible asset that can appreciate over time. When you invest in property, whether residential, commercial, or industrial, you are not only securing a place that's valuable in itself, but also gaining a potential source of income through rental payments. Why real estate is better than cash. Appreciation. Over the long term, real estate has historically increased in value. The price of land tends to rise due to population growth, urbanization, and limited space. While cash loses value due to inflation, real estate tends to keep up with or outpace it. Rental income. Real estate provides passive income through rental payments. Whether it's a residential property or a commercial space, tenants pay rent and you earn a steady cash flow. This makes real estate one of the best ways to create ongoing wealth. Tax benefits. Property owners benefit from significant tax deductions. These include mortgage interest deductions, depreciation of property value, and repairs or maintenance costs. This makes it an ideal way to reduce your taxable income while simultaneously building wealth. Risks to consider. While real estate is a relatively safe bet, it's not risk-free. Market fluctuations, natural disasters, or changes in zoning laws can affect the value of your property. Additionally, property ownership requires time and effort for maintenance and management, unless you hire property management services. 2. Precious metals. Gold, silver, and platinum. Gold, silver, and platinum are often referred to as safe haven assets. These precious metals have been prized for their value for thousands of years, serving as an effective hedge against economic instability, currency devaluation, and inflation. Why precious metals are better than cash. Hedge against inflation. Unlike cash, precious metals tend to rise in value when inflation increases. As the value of fiat currencies falls, the price of gold and silver often rises. This makes them an ideal tool to preserve wealth during economic uncertainty. Global acceptance. Gold and silver are universally recognized. Whether you're in the US, Europe, or Asia, these metals hold intrinsic value that can be easily liquidated. Tangible and portable. Precious metals are physical assets that you can store and transport with ease. You don't need to rely on banks or online platforms to access them. Risks to consider. Precious metals can be volatile in the short term. The value of gold and silver fluctuates due to factors like geopolitical tensions and changes in demand. Additionally, owning physical gold or silver requires safe storage, such as a secure vault or safe deposit box. 3. Dividend stocks. Steady income and growth dividend-paying stocks are shares in companies that pay regular dividends to shareholders. These dividends can provide a consistent income stream while also allowing for potential capital appreciation if the company grows over time. Why dividend stocks are better than cash. Regular income. Unlike cash sitting in a savings account, earning little interest, dividend stocks provide regular cash flow. Dividends are typically paid quarterly, offering you a steady stream of passive income. Capital appreciation. In addition to the dividends, the value of your shares can increase if the company performs well. This combination of income and potential growth makes dividend stocks a powerful tool for building wealth. Reinvestment opportunity. Many investors reinvest their dividends to buy more shares, which compounds their returns over time, a strategy known as dividend reinvestment plans, DRIPs. Risks to consider. While dividend stocks offer income, they come with market risks. If a company performs poorly or faces financial troubles, dividends may be cut or eliminated, and the value of the stock could fall. Diversification across various sectors can help mitigate this risk. 4. Peer-to-peer lending. High returns, high risks. Peer-to-peer lending, P2P platforms, allow individuals to lend money directly to borrowers, cutting out traditional financial institutions like banks. Borrowers typically repay the loans with interest, allowing you to earn higher returns than most savings accounts or fixed income investments. Why P2P lending is better than cash. Higher returns. P2P lending platforms often offer interest rates between 5% to 50% annually, depending on the borrower's creditworthiness. This is significantly higher than what you'd earn from a savings account or money market fund. Diversification. By lending to multiple borrowers, you can spread out your risk. Many P2P platforms allow you to diversify your loans across various types of borrowers, from individuals to businesses. Risks to consider. The biggest risk in P2P lending is borrower default. If a borrower cannot repay their loan, you could lose your invested capital. To mitigate this risk, it's crucial to evaluate borrowers carefully and diversify your loans. 5. Cryptocurrencies, digital gold for the future. Cryptocurrencies like Bitcoin, Ethereum, and other digital currencies have gained popularity as alternatives to traditional assets. Cryptocurrencies operate on blockchain technology, providing a decentralized and secure way to store and transfer wealth. Why cryptocurrencies are better than cash. Protection from inflation. Much like gold, Bitcoin and other cryptocurrencies are seen as hedges against inflation. The total supply of many cryptocurrencies is limited. E.g., Bitcoin has a cap of 21 million coins, which prevents them from being devalued by inflation or central bank policies. Decentralization. Cryptocurrencies are not controlled by any government or central authority, which means they aren't susceptible to the same risks as traditional currencies or banks. Potential for growth. Cryptocurrencies have experienced massive growth in recent years. While they are volatile, many investors see them as long-term wealth-building tools. Risks to consider. The biggest downside to cryptocurrencies is their volatility. Prices can fluctuate wildly over short periods, which can lead to significant losses. Additionally, there are concerns about regulation and the potential for government crackdowns on digital currencies. 6. Art and collectibles. Timeless value. Investing in art, antiques, and collectibles is an increasingly popular option for diversifying wealth. Art, rare coins, vintage wines, and collectibles are tangible assets that often increase in value over time. Why art and collectibles are better than cash. Long-term appreciation. While art and collectibles can fluctuate in price, historically, they've appreciated over the long term. High-quality pieces by renowned artists can be valuable investments that outperform the stock market. Diversification. Collecting items such as rare coins, fine art, or limited edition antiques allows you to diversify your portfolio in a way that is not correlated with traditional assets like stocks or bonds. Hedge against market volatility. Art and collectibles tend to hold value or even increase in price during periods of market instability, making them an excellent hedge against financial crises. Risks to consider. The primary risks in this space are the unpredictability of value and the illiquidity of certain items. Art and collectibles can take time to sell, and their value is highly subjective, making them a less predictable investment. 7. Bonds, a safer fixed income. Investment bonds are loans you give to governments or corporations, and in return, they pay you interest over time. When the bond matures, you get your principal back. Bonds are generally considered safer than stocks, especially government bonds from stable countries. Why bonds are better than cash. Regular income. Bonds pay interest periodically, providing you with a steady income stream. This is much better than keeping cash in a bank account that earns little interest. Diversification. Bonds can provide a counterbalance to riskier investments like stocks. When stock markets are volatile, bonds tend to be more stable. Risks to consider. Bonds are generally safer than stocks, but they still carry risks, especially if interest rates rise or if the issuer faces financial problems. Government bonds are the safest, but corporate bonds, especially from lower-rated companies, can be riskier. 8. Annuities, guaranteed income for life. Annuities are insurance products that provide guaranteed income for a set period or the rest of your life. They're typically used by retirees to ensure they have a steady stream of income in their later years. Annuities can be structured in different ways, including fixed, variable, and immediate types. Why annuities are better than cash? Guaranteed income. Annuities provide peace of mind by guaranteeing regular payments, regardless of how the market performs. This makes them ideal for retirees who want a reliable income without worrying about market fluctuations. Predictable and stable. While cash in the bank is vulnerable to inflation and the low interest rates offered by banks, annuities offer fixed, predictable returns that can outpace inflation, particularly when inflation is moderate. Tax deferral. Many annuities offer tax deferral on earnings until you begin withdrawals, allowing your investment to grow without the immediate tax burden. Risk to consider. Annuities can have high fees, and if you withdraw early, you may face significant penalties. Also, annuities tied to the performance of stocks, variable annuities, carry the risk of losing value depending on market performance. Furthermore, the amount you receive is based on the terms of the contract, and once you lock into an annuity, it can be difficult to access your money without penalties. 9. Commodities, investing in resources. Commodities are raw materials and primary agricultural products that are bought and sold, such as oil, gold, wheat, and natural gas. Commodities can be an excellent way to hedge against inflation and diversify your portfolio since their prices often rise when the value of cash and other currencies fall. Why commodities are better than cash. Inflation hedge. Commodities tend to rise when inflation accelerates, making them an ideal store of value in times of rising prices. This is because the cost of producing goods and services tends to go up, driving the price of the underlying raw materials higher. Global demand. Unlike cash, which is tied to the economic performance of a single country, commodities are in demand worldwide. As global economies grow, the demand for commodities such as oil, metals, and agricultural products increases. Diversification. Commodities provide a way to diversify away from traditional financial markets. While stocks and bonds can be affected by similar economic factors, commodities often move independently, making them an effective tool for balancing a portfolio. Risks to consider. Commodities can be volatile with prices affected by geopolitical events, weather conditions, and changes in supply and demand. The value of oil, for example, can fluctuate dramatically based on political instability in oil-producing countries or changes in environmental regulations. 10. REITs real estate without the hassle. Real estate investment trusts, REITs, allow you to invest in real estate without the need to own or manage physical properties. REITs pool investors' money to purchase income-producing real estate assets, such as shopping malls, apartment buildings, and office spaces. Why REITs are better than cash. Steady income. REITs are known for paying high dividends, often from 4% to 8% annually, making them a popular choice for income-seeking investors. Unlike bank savings accounts, which yield little interest, REITs offer much higher returns on a consistent basis. Diversification. By investing in REITs, you can gain exposure to the real estate market without the capital required to buy properties. REITs also diversify your portfolio by spreading your investment across various types types of real estate. Liquidity. Unlike traditional real estate, which can be illiquid and difficult to sell, REITs are publicly traded on stock exchanges, meaning you can buy and sell shares relatively quickly. Risks to consider. REITs are still subject to market risks, and their performance can be impacted by changes in interest rates, economic downturns, or a decline in the real estate market. Additionally, REITs are exposed to the risks associated with the property market, including fluctuating property values and tenant vacancy rates. 11. Mutual funds and ETFs, diversification made easy. Mutual funds and exchange-traded funds, ETFs, are investment vehicles that pool capital from multiple investors to purchase a diversified portfolio of assets. Whether stocks, bonds, or a mix of both, these funds provide an easy way for individual investors to gain broad market exposure. Why mutual funds and ETFs are better than cash. Diversification. One of the primary benefits of mutual funds and ETFs is that they allow you to diversify across a wide range of assets. Diversification reduces the risk that your entire investment will suffer from poor performance in a single asset class or stock. Professional management. Mutual funds are typically managed by professional portfolio managers who use their expertise to select and manage investments, while ETFs tend to be more passive, but still provide diversification at a low cost. Access to different asset classes. Both mutual funds and ETFs allow you to invest in various asset classes, including bonds, international stocks, commodities, and real estate, further enhancing your portfolio's potential for returns. Risks to consider. While they are diversified, mutual funds and ETFs are still subject to market risks, and their value can decline based on the performance of the underlying assets. Mutual funds also typically charge management fees, which can eat into your returns, and ETFs may not always be as actively managed. 12. Private equity, investing in private companies. Private equity involves investing in privately held companies that are not listed on public stock exchanges. These companies can range from startups to mature firms looking for growth capital. Private equity investments often provide higher returns, but they come with greater risks. Why private equity is better than cash. Higher returns. Private equity can offer significant returns compared to traditional investments like bonds or savings accounts. This is because you are investing in companies that are typically in their growth phase, offering potential for high capital gains. Control and influence. In some cases, private equity investors have a say in the management and direction of the company, providing an opportunity to add value and influence the company's success. Diversification. Investing in private equity allows you to diversify away from public markets and explore opportunities in industries or companies that might not be available through traditional investments. Risks to consider. Private equity is highly illiquid, meaning you may not be able to sell your investment for several years. Additionally, investing in private companies carries the risk of failure, especially in the case of startups or high-growth ventures. It's important to conduct thorough research and diversify your private equity investments. 13. Foreign currencies, hedging against currency devaluation. Investing in foreign currencies can be a smart way to protect your wealth from devaluation or inflation in your own country. By holding foreign currencies, you can potentially benefit from favorable exchange rates when the value of your domestic currency falls. Why foreign currencies are better than cash. Protection from domestic currency. Devaluation. If you live in a country with high inflation or political instability, holding foreign currencies such as the Swiss franc, the US dollar, or the euro can provide a safer store of value. Diversification. Currency investments can provide diversification away from the financial markets and traditional investments. Foreign currency markets are often less correlated with stock and bond markets. Potential for growth. By trading foreign currencies, Forex, you can take advantage of changes in exchange rates to generate profits. Forex trading allows you to speculate on the rise or fall of currencies, offering a high-return investment opportunity. Risks to consider: Forex trading is highly speculative and volatile, and it requires in-depth knowledge and experience to be successful. Additionally, currency investments are subject to political risks, such as changes in government policies or economic sanctions that could impact the value of currencies. 14. Cash flow real estate, steady passive income. Cash flow real estate involves investing in properties that generate regular rental income. The key here is buying properties where the rent payments exceed the cost of ownership, including mortgage, maintenance, taxes, and insurance. This creates a steady stream of passive income. Why cash flow real estate is better than cash. Regular passive income. Unlike cash, which earns little to no interest, cash flow real estate offers regular monthly income through rental payments. This makes it a reliable and stable way to earn money over time. Capital appreciation. In addition to rental income, real estate typically appreciates in value over the long term. By investing in cash flow properties, you get the dual benefit of passive income and asset growth. Tax benefits. Cash flow real estate offers tax advantages, including deductions for property expenses, mortgage interest, and depreciation, which can reduce your overall tax burden. Risks to consider. Real estate investments require significant upfront capital, and there are ongoing responsibilities such as maintenance and management. Moreover, tenants may not always pay rent on time, leading to temporary cash flow issues. Market fluctuations and property value declines are also risks to consider. In conclusion, keeping cash in the bank may seem like a safe and convenient option, but it doesn't offer the growth or protection you need in today's economic climate. Whether you're interested in real estate, stocks, or cryptocurrencies, these 14 assets provide better opportunities to build wealth, preserve your purchasing power, and hedge against inflation and market volatility. Each of these alternatives has its risks, but by diversifying your investments, you can create a strong financial foundation for your future. Remember, wealth isn't built by sitting on cash. It's built by making your money work for you. Thank you for watching, and don't forget to subscribe to the channel for more valuable insights on how to grow and protect your wealth.